So on the way in today, Mr. Posen told me he disagrees with everything in the paper that I'm about to talk about. So I think we'll have an interesting panel discussion afterwards. For those who aren't familiar with the paper, our firm attended the first colloquium that was hosted by a new body called the American College of Governance Counsel, which is an association of experienced governance lawyers in the United States and Canada. And we wrote a paper about this colloquium, which was published in the Delaware Journal of Corporate Law. And I'll give you a short and sweet version of this, so hopefully we'll all get you to lunch in time. So essentially, the bottom line in terms of the role of accountants and auditors comes down, as Catherine mentioned, to trust. It's so important to increase trust and build trust between investors and the corporations in which they are investing. Now, the perspective of the Governance Council is very much about, these are counsel who advise the boards of the corporations. And so their perspective, as expressed at the colloquium, was really about how boards can regain that trust, how the directors can regain that trust, instead of being in a situation where they find themselves in context of being at, as they call it, at war with their shareholders, at war with their investors. And I think in that context, one of the primary concerns that was often being expressed was about activist investors. So you do get situations where you've got people like Bill Ackman, Carl Icahn, who are coming in and they are saying, while I see an opportunity here to buy in to a corporation a significant number of shares, which brings me with a significant number of votes, change who's going to be on the board of that corporation, and use that change to then further an agenda which will increase short-term value, and then I can sell off my shares. So the way Carl Icahn would say it is, you want to increase the odds so they are greatly in your favor. You don't want to just wait until the odds turn into your favor, what you're holding increases in value and hope for the best. You want to actually take charge of that, be proactive, take control of that. Which does sound lovely when you put it that way, but the challenge that goes along with that is that it can be and often is at the cost of the long-term interest of the corporation, which then in turn can also be problematic for certain long-term interests of society. And as an example of that, if what you're looking at is, how much can I increase the share value in the next quarter? Or how much money can I actually get out of the corporation in dividends on these shares in the next quarter? How much can I get right now? You're not putting that, you're taking that money out for the shareholders, or you're selling things off fast, you're cutting overhead, you're cutting employees, you're cutting research and development, and that's all money that's not going into building the long-term value of the corporation. And so when you're not putting money in research and development, you're not looking at, well, what's really going to make us relevant in 10 years? You're not looking at, okay, these employees have been loyal to me, so I'm going to build that culture of trust within the organization and loyalty. Instead you're saying, no, I'm going to cut costs now, and by laying off a lot of people, and not think about what that does to, say, risk management over the long term, your ability to hire more quality people over the long term. So that's the real challenge. That's the challenge that came up over and over again as Governance Council discussed what's on the minds of directors and their advisors at this colloquium is to have that space. So, to give it some more context, and I can get into this a bit more as to some of what was the technicalities of what was discussed. Boards historically did have a lot of space to exercise their business judgment about what is best for the corporation, and they can take into account long-term and short-term interests in doing that. And the idea is, Mr. Posen may disagree later, but the idea expressed was that nobody's in a better position than the directors to exercise that judgment. And that, in a sense, that's what the courts say. They have something called the business judgment rule, where if people come and challenge board of directors' decisions, they have a lot of deference to the exercise of that business judgment. So they're elected by the shareholders to run the corporation because of their experience, their industry knowledge, if they have been in that role for a long time, for example, they may know quite well the nuances of the risks and opportunities that are facing the corporation and the particular industry that it's operating in, which may not be apparent to everybody who's just watching things from the outside and thinking, do I have an opportunity here to make change that will increase the share value? And so historically, there was a lot of space for directors to exercise that judgment, but that's been, at least in the U.S., really changing. The council was really, the colloquium fellows were really talking about the challenges that have come with that change. So over the years, particularly in the United States, there have been a lot of development since about 1985, where shareholders gained more and more power to influence the way that corporations were governed. I think as a starting point, there were definite reasons for that. There was definitely a concern that corporations were being run by the old boys network. People were being put into board positions because of who they knew, not necessarily being held accountable for all of their decisions and how they were making those decisions. And so both the courts and the legislature started giving more ways for shareholders to have a voice and to participate really in making changes to the corporation. So that, for example, came about in 1985. There was a decision in the States called Unical that upheld the power of the board to reject a hostile takeover bid. So if somebody else wants to come in and buy all the shares and take over the company. And then there was a household case that affirmed the legality of the poison pill. So that validated the board, the board's model of governance, the board-centric model. But then in that same year, 1985, there was a year of new beginnings for advocates of shareholder-centric governance. And there became increasingly more and more ways to essentially hold boards accountable by saying, like, for example, plan investment managers under pension laws in the States were directed by government policies to exercise their voting authority in the interest of plan members without clarifying that those interests could be long-term interests in nature. There were the development of the Proxy advisory firm, so that in order to fulfill that duty, investment plan managers are kind of looking for guidance, they're looking for advice. I mean, they're on the hook now. So how do I exercise my votes in the interest of plan members? Well, I can say I relied on advisors, which is very helpful, which is great. You've got institutional shareholder services, which then creates recommendations, and a lot of people follow them, and so that has a huge influence on how things are voted. But again, what's happening is that you don't necessarily get all the nuance of what's behind the decision. So as Catherine said, sometimes it's true, sometimes it isn't, right? Like sometimes you're looking at a very much what they called a tick the box approach to, if executive compensation went up a lot in the last quarter and people think that, doesn't look right, they'll recommend voting against people who are on the committee to continue, the committee that approved that, to continue as directors. But maybe there were other reasons for it. One example that came up at the colloquium was, well, if somebody's missed a lot of board meetings in the past year, then sometimes that would be a recommendation to vote against them being a director again. But sometimes they had extenuating circumstances that there isn't always room to explain all of that in the context of these standard forms of disclosures and recommendations. So the concern was, again, with this idea that you're not getting all of the benefit of the nuance that the directors have when they're the ones who are closest to how things are being run. So that was all expressed in the pre-read material that kind of set the tone for the colloquium. And what was suggested was that the solution to that, again, is really to have more communication, more transparency, and more trust between boards and shareholders. So like if boards are doing a better job of communicating what are the reasons for the decisions we're making, what are the reasons why we're recommending people to continue on the board, for example, and communicating those nuances, then shareholders are in a better position to make good decisions and also to trust the boards. And so the more that you have that good communication, the more well, I guess the better it is for everybody. Yeah. So that was the setup for the conference. That was the pre-read material and the history. And we got into a lot of discussion. People broke out into little kind of small group tables and discussed certain themes. And the themes were, again, the culture of short-termism, the increased influence of shareholders on corporate decisions. There was something called a double agency problem, which is a bit tricky, but essentially what's happening is that you don't always know. It's not always just like each individual person voting for who's going to be on the board. It's like shares are held sort of on behalf of other people up the chain. And then those get kind of consolidated into a big block of them held together, and the votes exercised in a certain way, so you're not getting the participation of each individual shareholder in that voting process. So that also was one of those kind of challenges in terms of having a dialogue between the boards and the shareholders and having everybody understand the implications of voting a certain way, and the positions that sort of the corporation's current people currently running the corporation were taking and trying to articulate, and why they were recommending the people they were recommending. And then at the end of the colloquium, there was a very interesting keynote speech by the Chief Justice of the Delaware Court. And he proposed a lot of interesting measures that might also help with resolving these issues and overcoming short-termism. He's known for taking some extreme positions, but I thought the most interesting one that he brought up was actually, he suggested a tax on short-term investors, so that if people are going to, because he says really what's happening is your average person, and this comes back to the double agency problem sometimes too, but your average person who's investing is thinking about the long term. They are thinking, I'm saving up for my retirement, I'm putting my money somewhere, I'm trusting people to manage it for me, and I'm hoping that it will increase over the long term for my retirement. I'm not thinking quarter to quarter necessarily. I'm thinking about what is going to gradually increase. And so those people do have interests that are aligned with the corporation and hopefully with the people who are governing the corporation. Whereas other people, such as Carl Icahn, are looking at, okay, I'm really thinking about right now. How can I make money right now? I'm buying a share today. I want it to be worth a lot more next week. I'm going to sell them all then anyways, and I don't care what happens to the corporation. So his solution was that people who are buying and selling on short-term basis like that would be taxed, and then that money would go towards things that would help the policy goals that were being potentially detrimented by these short-term decisions. So, for example, things like employment insurance. If you're laying off a lot of people in order to save costs in the short term, you need more employment insurance benefits to cover that. So the tax would go to, or to the environment, because if you're, again, thinking about short-term profit for a corporation, then that could be detrimental to the environment in which it's operating, because if all you're thinking about is short-term profit. So the tax on the short-term investors would go towards resolving those concerns. Now that was probably the most controversial thing that came out of it, and I don't know that it's going to happen anytime soon, but it was a very interesting idea. Some other things that he suggested would be, rather than voting every year. On executive compensation, you could do it every 3 years. Oops, did I press a button there? There.
That's already what happens in the Netherlands.
Oh, okay, so there you go. So that one's a more realistic suggestion. And then also a 3-year approach to proxy reimbursements at companies without a classified board. So the idea there is if the current board of the company or management of the company puts forward a sort of a list of people that it recommends to be elected as directors, and then somebody else wants to put up a competing list of people to be elected instead, then they can be reimbursed for the costs of circulating that to everybody, to all the other shareholders, right? And so his idea is that they would only be reimbursed every 3 years, so it wouldn't happen as often, or that also that would only be available to people whose candidates were actually got a credible percentage of the vote. So if you're just saying, I want a totally different set of people and I'm going to advertise that they're better, then he thought that, well, you shouldn't necessarily be paid for the cost of doing that unless it looks like people actually, are voting for those people, and therefore it's kind of a viable option. Now, I'm not saying I agree with it, but it's an interesting mechanism that he proposed. Is it my turn? Is it my time?
A few more minutes.
Okay, great. So I'll just turn to the conclusion. So concluding with the thoughts for the future of governance, there was a strong consensus during the discussions that an organization's governance is a key determinant of whether its business is managed for short-term results or for the creation of sustainable value. There was also broad agreement that in order for governance practices to better support long-term value objectives, the relationships between shareholders, and particularly activist shareholders, and boards must be realigned. The fellows noted that directors can contribute to better alignment with shareholders by using transparency and shareholder engagement to build trust. So many noted that because of the influence of proxy advisory firms, there has to be a lot of open line of communication with investors so that people are understanding the nuance that's coming with the recommendations or that is behind the recommendations coming from the companies. And improved dynamics between boards and shareholders will also help resist opportunistic attacks by activist investors. So if you've got a lot of long-term investors that do trust the board and the company, then you're less vulnerable to people coming in and changing everything. So essentially, the role of accountants and auditors is very important because if they can identify wrongdoing where it does occur, then when they give a clean bill of health to corporations, then that really means something, and then shareholders can trust the governance of the corporation. And so that goes for outside counsel as well as for accountants and auditors. So, for example, our firm is independent, so it's important to have independent advisors for the directors that aren't relying on a long-term relationship with the management of the corporation in order for their business model. So often at a large firm, you have people that have what they call a book of business, and they do all the kind of the standard routine day-to-day things for management, and so they are not independent. They can't, if the board needs independent advice on whether management is doing a good job or doing anything wrong, then you can't be hiring an outside advisor that is sort of dependent on having a good relationship with management. You need an independent counsel to come in. And then the same thing with accountants and auditors. They have to be independent again. So that expert independent advice is key to building the trust between boards, corporations, and shareholders.
Thank you.